with the existing frameworks and the anticipated legal, economic, social, and diplomatic implications. So here we are presenting this bill, knowing that Bank of Uganda, in the fulfillment of its constitutional mandate as the primary steward of monetary and financial stability, we are submitting this technical assessment regarding the protection of the Sovereignty Bill 2026. Chairman, allow me by quoting Article 189 of the Constitution of the Republic of Uganda, which prescribes that the function and the services of that are specified in the 6th schedule of the Constitution, including banks, banking, promissory notes, currency and exchange controls, shall be the responsibility of government. And Para 3 of the 6th schedule explicitly reserves these functions for the government, while Para 11 and 12 address the foreign relations and external trade. Now, compare that with Article 162 of the Constitution of the Republic of Uganda, which, when read together with Section 4 of the Bank of Uganda Act, Chapter 54, and Section 143 of the Financial Institutions Act 2004, the government of Uganda, by establishing the central bank as a statutory body, has delegated its functions under the Constitution to the central bank and given it the constitutional and regulatory primacy over all matters concerning the formulation and implementation of monetary policy directed to economic objectives of achieving and maintaining economic stability for the Republic of Uganda and on behalf of the government of Uganda. Now, Article 162, subsection 2 of the Constitution clearly protects the Bank of Uganda from being subject to direction or control of any person or authority in performing its functions. Therefore, any legislative or administrative action that introduces parallel oversight or restricts the operational independence of the Bank of Uganda risk contravening these constitutional provisions and undermining the legal and institutional framework for the financial sector governance. And Chair, in addition, with respect to matters concerning financial institutions, the Financial Institutions Act takes precedence over any enactment, and in case of conflict, it shall prevail. So that's the basis on which we are going to make our technical assessment. Now, we also note that for the avoidance of any doubt, Bank of Uganda is established to protect the national sovereignty from foreign interference as enshrined in section in Part 4 of the Bank of Uganda Act. And here I was saying, however, while protecting that national sovereignty is a paramount constitutional objective, the financial system's technical architecture must remain shielded from regulatory fragmentation. This assessment argues that the bill in its current form risks introducing regulatory fragmentation and subjecting this economy to voluntary shocks, potentially undermining the very economic strength upon which true national sovereignty is built. Now, Chair, let me look at the technical review of the legislative provision and the regulatory alignment. Here, I'm going to look at what are the core principles and the key provisions that we are going to address. Now, the bill designates the Department of Peace and Security in the Ministry of Internal Affairs as the central regulator for agents of foreigners. Its primary technical mechanisms include, in Clause 1, expansive definition, where an agent of a foreigner is defined, and then it also introduces the cabinet gatekeeping under Clause 6, which prohibits any agents of a foreigner from performing the functions or the services for which government is responsible. And then the other one is to do with the mandatory registration, which is in clause number 14, that requires entities to register with the Ministry of Internal Affairs and obtain a certificate valid for 2 years. And then there is another clause, 22, which is foreign funding restrictions that imposes a cap of 400 million shillings, that is 20,000 currency points. And then the other clause 23, subsection 3, the vicarious liabilities, the penalties. And then clause number 25, the enforcement via financial institutions, which prohibits banks from paying out funds to foreign agents without verifying ministerial authorization, and the civil penalty of 4 billion Uganda shillings for non-compliance. And then, Chairman, the one that concerns us is economic sabotage, which is clause number 13, which criminalizes the publication of information that weakens or damages the economic system and is punishable by up to 20 years in prison. So, we are now going to go through clause by clause technical assessment. Here, we are noting the key conflicts between the bill's provisions and the existing financial regulatory framework as highlighted in the table below. So we cite the clause, the key issue, the conflict, and our recommendation for refinement. The first one is defining what an agent of a foreigner is. The key issue is that this bill has broadly defined it. It captures even own fintechs, Uganda's abroad, and then the conflict with the existing framework is that it overlaps with the Bank of Uganda Prudential Supervision under the Financial Institutions Act 2004. So what are we recommending as a refinement? We think that we should exempt supervised financial institutions licensed by Bank of Uganda, Capital Markets Authority, or development finance institutions from this provision. And then the registration requirement, the dual licensing of SFIs must, where they say that SFIs must register with the Ministry of Internal Affairs. We think that this is creating regulatory arbitrage. So we are proposing as a refinement, we carve out a carve out for the supervised financial institutions, licensed and supervised by Bank of Uganda. And then clause number 16, the suitability inquiries. And here, the provision of mental, fiscal, and health checks for directors, that's what is in the bill. We think that it does exceed Bank of Uganda's fit and proper standards, which may deter qualified professionals. So we want to align it to Bank of Uganda's framework or remove the health inquiries. Now, the rest, in the interest of time, can be read. But let me now look at the interaction and conflicts with existing frameworks, the parallel regulatory regime that overlaps with the established mandates, creating dual licensing. The first one is constitutional. Article 162 of the Constitution, which mandates Bank of Uganda to promote development and maintain independence. Now, if you interact with the bill introduces ministerial oversight that conflicts with the Bank of Uganda's exclusive mandate. And then the Financial Institutions Act 2004, the prudential supervision of fit and proper vetting. Clause number 14 creates a dual licensing. It also introduces overlapping suitability in clause number 16. And in the National Payment Systems Act 2020, the oversight of cross-border transfers and payments providers is a core function and mandate of the central bank. But what this bill is now proposing that under clause 25, it imposes gatekeeping duties and a 4 billion civil penalty on the providers. And then the Anti-Money Laundering Act, the source of funds and violations reporting are all covered under the Financial Intelligence Authority. But clause number 21 creates a parallel reporting channel, public inspection of declaration, which violates the banking secrecy. And then the other one is to do with the Organizations Act, which restricts contribution from foreign sources to political parties to 20,000 currency points within the period of 12 months, and so it also prohibits political parties from demanding equivalent of 200,000 currency points. So we are seeing that the interaction with the proposed bill is that Section 13 has similar restrictions as introduced in the proposed bill which are only limited to political parties. Now, Chair, let me go to the most important aspect of our presentation. What are the comprehensive assessments of this bill? Chairman, let me be very clear from the outset. This bill is about cross-border payments. And cross-border payments is about the balance of payments, because the balance of payments is a comprehensive record of all economic transactions between a country's residents and the rest of the world over a given period of time. It tracks the inflows and outflows of money from trade in goods, services, and financial assets. The balance of payments is divided into current account balance and the financial account, and of course the capital account. Now, what is the case of Uganda? The case of Uganda is that the current account balance has always been in the negative because our imports are far much greater than exports. So how do we close this? Is through financial flows. Financial flows into the financial account. And where these financial flows exceed the deficit in the current account, that's how we build reserves. Now, what is this bill doing? This bill is bringing restrictions into cross-border transactions, meaning that it is bringing restrictions on the inflows to this country. And we run a risk of reducing substantially the inflows into Uganda. And if we reduce these inflows into Uganda, it means that our current account is even going to widen. And with the restrictions, there will be limited inflows in the financial account, which is going to make it very difficult for us to finance the widening current account balance. So how then does the balance of payments balance? We are going to have a substantial depreciation of the currency, because you need to make imports more expensive in order to equate imports to exports. So this is the main risk of this bill. And also, it means that our capacity to build reserves, because now the flows in the financial account are reducing, we won't have an excess of financial flows in the financial account over the current account balance to build reserves. And Chairman, a country without reserves is not sovereign. So, the most important thing is, how do we deal with this? If you look at, for example, what is being proposed, the potential of this bill to destabilize Uganda's balance of payments is our primary concern as a central bank, because it affects cross-border flows. For example, last financial year, the overall balance of payment surplus was 1.5 billion, meaning that the financial inflows in the financial account were in excess of the deficit in the current account balance by 1.5 billion. And that's how we were able to increase our reserve coverage by 1.5. Today, as we talk, our reserves are close to $6 billion. Why? Because these inflows have been coming in. The moment you tamper with these inflows here, we risk running down our reserves. And that is economic disaster for a country. So, these inflows were driven by foreign direct investment of 3.4 billion, portfolio investments of 2.1 billion. Remittances. We are now requiring that remittances, if there's a Ugandan in the diaspora, he's a foreigner by the definition of this bill. And anybody who receives these remittances in excess of 400 million is an agent of a foreigner. He has to be registered by the Minister of Internal Affairs. Honorable members of Parliament, for remittances that are sustaining the livelihoods of Ugandans, we are likely to see even a reduction in the remittances. I don't know what the diaspora people told you, but this is likely to come down. Last year, we got remittances of 1.5 billion. And so it means that we are going to have pressure on our currency. And then the most the most striking thing also is, if you look at our securities market, government of Uganda is undertaking significant borrowing to finance its budget. And if you look at the holding of government of Uganda securities by non-residents, by these foreigners, they are holding to close to about $3 billion, which is about 12% of the securities that have been issued are held by this. And going by the definition in this bill, where ministerial approval for the threshold is acting as a capital control, experience in other jurisdictions shows that it leads to immediate exit of the offshore investors. And when they exit, it means that we cannot fully finance our deficit through borrowing. And if we are going to finance, it's going to be through very high interest rates. And as they exit, it will have impact on our currency. And then the other issue is clause number 13 about economic sabotage, that at the publication or anything that causes the weakening of a system is qualified as economic sabotage. Now, Uganda's debt servicing is currently about 50% of government revenue. By criminalizing economic research that identifies fiscal instability, as in clause number 13, the bill destroys what we call price discovery. Because if I'm an investor, I need to look at all the information about an economy, then I price based on that information. So when I don't have that information, because we don't have, the bill has said don't publish anything that weakens the system. What do I do if I'm an investor? I'm going to put what I call uncertainty premium, all right? So that if I had discounted for the fiscal instability or because of the high fiscal deficit into my pricing initially, now I don't have that information. I'm going to put uncertainty premium. So if I was bidding for a 25-year bond at 17%, I'm going to end up bidding at 20%, just in case I've got it wrong. Why? Because I don't have information. Markets rely on information, a wide array of information to do their pricing. So clause number 13, in our view, is going to distort price discovery. When we publish a report about maybe inflation is projected to rise or the currency may depreciate, so we need to tighten monetary policy to do that. Now, if tightening of monetary policy leads to lower credit growth and the economy weakens, will I be charged with economic sabotage? Then the other issue is financial sector, de-risking and operational paralysis. The banking industry faces a systemic threat from financial de-risking and regulatory overlap. The corresponding banking that facilitates trade and clearing transactions. These banks operate on a zero-failure compliance environment. If routine operations like capital injections or trade financing clearing require ministerial approval, international banks are likely to terminate relationships, therefore isolating Uganda from the global payment system. The recruitment deterrent. Clause number 23, subsection 3, with its liabilities, and clause number 16 of intrusive suitability inquiries, including fiscal health, may deter qualified professionals from participating in the governance of the Ugandan financial institutions. Colleagues, honorable members of parliament, I want to be very frank here. When we are looking for board of directors for financial institutions, this is a skill that is still very scarce in Uganda. Now, most of these financial institutions have ended up getting skills from abroad into their governance structures. Now, with these very, very intrusive suitability requirements, it will be difficult for these supervising institutions to get these skills. And therefore, we are likely to end up with weak governance in the financial institution. And then procedural disruptions. there's a lack of the commencement clause. So when this bill, if passed, when does it become operational? There's no transition time given, but that's another matter. And then in terms of the capital requirements, you all know that Tier 1 banks require 150 billion, Tier 2 require 10 billion, Tier 3, 4 require 1.5. Now, this cap would severely restrict capital injections, intercompany shareholding loans, and correspondent banking, all of which are essential for liquidity management and regulatory compliance. And then the policy framework, and this is, Honorable Members of Parliament, this is a very, very important point. Since 1990s, the Uganda's successful and sustained economic recovery has been built on policy predictability. What this bill is introducing, it is introducing what we call time and policy inconsistency. That is going to threaten the tenfold growth that the government of Uganda is aspiring. If you look at our investment levels that are required, they are far much lower than the savings we have. So we require foreign capital to fill up this gap. Now, if we are going to grow the economy to $500 million by 2040, we require annual FDI to rise to about $50 billion. And we require domestic savings to start to 40% of GDP. Now, the administrative restrictions that this bill is creating is not going to make this possible. So what happens to our tenfold growth? Because this is going to slow it all down. So we need to look at how is it affecting other policy objectives. And then, because the bill is so restrictive in regulation, is likely to drive actors into informality. We are going to have informal channels again coming back. Think like the Hawala systems or the unregulated financial instruments, which is eroding the tax base and undermining the bill's stated goal of transparency. Honorable Members of Parliament, in 2024 that Uganda came out of the Financial Action Task Force grey list. Why? Transparency was one of the key issues. So we are trying here to increase transparency as much as possible. Now, if the bill is going to create informality and therefore raising transparency, what are the chances that we might get back into this? It's something for each of us to ask ourselves. And then these institutions already are operating effectively under well-established statutory mandates, and reaffirming their primacy would preserve the regulatory coherence and accountability, avoid geo-licensing and inspection.
Is given to us by the Anti-Money Laundering Act, CAP 118, and our core mandate is to combat money laundering, financing of terrorism, and profession financing. And Chair, for us to be able to undertake this assignment, we collect and analyze all the financial data to detect illegal activities like money laundering, fraud, terrorism financing, and other crimes which generate proceeds which are laundered. Government relies on this intelligence to maintain economic stability and national security. Chair, we identify suspicious transactions and we track criminal networks, and therefore this helps to reveal the threats to national security, organized crimes, and terrorism financing. Chair, in line with that, we responded to the request which you gave us, and there are 3 areas which we are going to address ourselves. Chair, notwithstanding all what has been said, our presentation was, in the likelihood that this bill continues to be enacted as law, we have concerns with specific areas which we think these areas should be addressed. And Chair, we have issue on the interpretation of agent of a foreigner and a foreigner. And Chair, we think that this definition should be harmonized with the existing anti-money laundering legislation to avoid ambiguity in reporting obligations by the accountable persons as specified in the Anti-Money Laundering Act. Chair, if the definition remains as it is, it's going to cause a lot of confusion, especially to those entities which has a mandate. And Chair, we have an opinion that there should be exemptions in terms of the entities which are operating in the country. Chair, we moved straight to clause 14. Most of our submission relate to those specific clauses which have effect on our mandate. Chair, there is a registration of agent of a foreigner, and specifically it talks about a person shall not act as an agent of a foreigner unless the person is registered with the department and issued with a certificate of registration by the minister. This is something which we feel that we should have exemptions like the governor has indicated, especially the supervised financial institutions, because there is an elaborate processes which provide for this. So the Financial Intelligence Authority regulates entities that facilitate financial transactions, and this is through working closely with the supervised financial institutions to determine customer due diligence and disclosure of beneficial owners' information. This bill, if it remains as it is, will create parallel registration regimes and will duplicate regulatory oversight, which is likely to cause confusion within the operations of the different players. Chair, we propose that the bill should be harmonized with the existing legal and regulatory framework on licensing and registration, especially those under the purview of the supervisory institutions or supervisory bodies. The bill should provide for access to information on whichever definition they will have come up with on foreign agent transactions upon request or spontaneously reported by the law enforcement agencies, because there is a mechanism through which government can get this information within the regulated systems. Chair, the justification is that the supervisory bodies and supervisory institutions are required by law to keep and maintain information which will be including these foreigners and agents of foreigners as per the definition which we would have come up with. So we don't need to have these parallel registration regimes and duplicate the regulatory oversight, since we already have. Chair, we move to clause 21, and this is the one which talks about the declaration of the source of funding. And Chair, this is our cardinal mandate and principle, where we require all transactions, both domestic and those which are coming from foreign jurisdictions, to be declared by those entities which process. And Chair, when you look at the Anti-Money Laundering Act, Section 9, subsection 1, it provides for reporting obligations by accountable persons, and it requires that each cash and monetary transactions involving a domestic or foreign currency exceeding 1,000 currency points, which is equivalent to 20 million Uganda shillings, should be declared and sent to the Financial Intelligence Authority using a Form A, as may be appended to the regulations made by the Minister on the advice of the authority. Chair, we are proceeding to require that all the international wire transfers are also declared. This does not matter on the threshold of the 20 million which I alluded to, but this will enable us to capture all transactions which are destined to Uganda in that requirement. So to make it specifically, currently it is being implemented by the financial institutions, but we are proposing an amendment in the Anti-Money Laundering Act to have it also as part of the provisions. But the banks are complying because we have, through the guidelines, required them to declare international wire transfers. And Chair, that would be the only missing link where transactions of cross-border in nature, which could have a small loophole, because the law provided for the 20 million threshold, but like I indicated, we are also able to get all the inflows in the country, and therefore there is no gap in terms of government getting access to all transactions which are coming from foreign jurisdictions to this country, and the funds which are destined to other jurisdictions from Uganda. So all the cross-border transactions are therefore accurately and timely reported and monitored by the Financial Intelligence Authority. Chair, to clause 21, a declaration submitted under section 1 shall be available for inspection at the office of the minister, and the department may allow access by payment of a fee prescribed under this act. Chair, access of financial information by members of the public upon payment of a prescribed fee is irregular. It's very, very irregular because it breaches confidentiality clauses, data privacy and protection laws, and the Anti-Money Laundering Act, among others. Access should be provided only to law enforcement agencies for purposes of investigations and to the competent authorities for licensing and regulation by supervisory bodies. It is very, very irregular for a member of public to pay a fee to access private information, which is at the Ministry of Internal Affairs. I don't think that should be proper, and that should be removed in the requirements. Clause 22, restrictions on funding from foreigners. Under the Anti-Money Laundering Act, Cap 118, financial flows are not pre-approved, but monitored, and the suspicious ones are the ones which are supposed to be reported or followed by the government. The FIA relies on a risk-based post-transactions monitoring reporting system, and therefore, what the bill is proposing is that this risk-based post-transaction system are replaced with the executive pre-clearance, which will require somebody to seek clearance from the ministry to be able to transact. Such undefined discretion may undermine lawful financial transactions. Therefore, this should be considered for appropriate address. So, Chair, the provisions of the bill should be harmonized with the existing anti-money laundering legislations, such that if this bill is to continue to address those issues of concern. In terms of Clause 24, foreign funding to government institutions, we have no comment. Clause 25 is about reporting foreign funding. The mandatory periodic reporting, which the bill is proposing, is a preserve. For example, it is only the Financial Intelligence Authority which has the mandate to receive suspicious transaction reports, and international standards require that such transactions should be reported in one center. So the bill will therefore create dual reporting obligations for supervised institutions, and therefore there is need for these provisions to be harmonized with the Anti-Money Laundering Act, which allows only FIA to receive, process, analyze, and disseminate this received information to competent law authorities in Uganda. In Section 21D of the AMLA, the mandate is also given to FIA to make the information collected by it available to competent authorities and to facilitate the administration and enforcement of laws of Uganda. Therefore, there are sufficient provisions for government to receive this information if it needs, and this should be aligned. If there are any other gaps, the Anti-Money Laundering Act can be reinforced to cover some of the missing areas which necessitate government to enact another law which seems to be having similar provisions and similar intentions as the Anti-Money Laundering Act. If you look at Clause 27, this is the final one we are submitting, assistance to the minister. The bill should be harmonized with other existing laws to widen the scope, which requires ministries, departments, and agencies to accord the minister the necessary assistance for purposes of giving full effect to the bill. Otherwise, as it will contradict other provisions which don't require certain information to be shared as is. In conclusion, Chair and members, we feel that the current Anti-Money Laundering Act as is sufficient to provide the information which this bill is seeking to get by registering and tracking cross-border movement. I submit.
Thank you.
The end. Chair, the consequences, we call them unintended consequences, which this bill might introduce. And Chair, of course, given the good intentions at the Financial Intelligence Authority, we think that this bill may create some unintended consequences, which will be increased informality and illegal channels of financial inflows into the country, such as alternative value transfer systems, including the use of the hawalas, the virtual assets, and this may obscure the visibility of such transactions by law enforcement agencies. Chair, it has also been indicated that there are likely to be reduction in remittances by Ugandans in the diaspora. There is also likely to be economic disruptions. And Chair, the mandate overlap, which may create institutional conflict during implementation, and the issues of de-risking and financial exclusion, as banks and other accountable persons may consider such persons as high risk. So these are some of, Chair, the consequences which might be created by enacting this bill as
Okay.
is.
Thank you. Honorable colleagues, I think we...
Under the enactment of this bill by the executive, to me sounds like a vote of no confidence in your services as the Financial Intelligence Authority. And this could be that either you have failed on your mandate or there are inabilities in the existing law that must be improved in order to enable you to deliver your mandate effectively. Could there be any that you may cite, for example, in the Anti-Money Laundering Act, that could probably help you deliver better to the expectations of your appointing authority? I thank you.
Thank you. Honorable Nsibambi.
I want to thank the governor and the team from Financial Intelligence Agency. I just have one issue for clarification arising out of 23.3 on page 3, vicarious liability. Mr. Governor, your role or duty is to do a prudential oversight and risk management. But your observations to do with the vicarious liability of directors, you say this should be removed. You are dealing with, I don't want to call them your sons, but banks and financial institutions. Most of them are artificial entities, meaning that they're acting through a medium of human beings because they're artificial entities. They are persons, but artificial. And as such, not being human entities, they act through a medium of human beings as the directing mind and will of those entities, the nerve center. Is there a possibility of taking the memorandum and articles of association in the dock in case of liability? You definitely have to take the human beings. So if they're not vicariously liable, the only option is to get the books, the resolutions, and you put them in the dock. So when you remove this, how are you going to exercise and monitor the performance of functions which are illegal by human beings on behalf of entities?
Thank you. Thank you, Honorable Nsibambi. Honorable.
That has come into Uganda, and that money went into influencing, went into interference, went into threatening, went into misinforming, went into political engagements, went into recruitment, as listed under the bill in 2.2. And if that money came, what actions did you take as the Financial Intelligence Authority, having traced that amount in the various parameters listed by government? I want you to tell us if that has ever happened. Now, to Bank of Uganda, you are independent in your operations. My understanding also is that you should not be influenced unduly by different pressures because of the central role you play as a bank. Under Section 4 of the Bank of Uganda Act, it may have changed, but one of your cardinal roles is to advise the government on monetary policies. My question is, did you get opportunity to advise government on the monetary implications of this shift regarding this bill? In other words, how have you interacted with the executive particularly touching what you have presented to us, and how did they, if that opportunity was there, what feedback did you get from the executive? The second issue is the bill's attempts to regulate, I think, money supply, as you have stated. I think that's the core. They want to regulate. Now, this is also, under the Act, a sole or a core responsibility of Bank of Uganda to regulate monetary supply. So, in this bill, the government is attempting to designate a department responsible for those inflows. Balance of payment likely to go into deficit, the reserves may be depleted, interest rates may rise, exchange rates, our currency is going to get weakened, the capital flight, all those that you have. Are you, as Bank of Uganda, ready that once this bill is signed, like tomorrow, you have already processed it and you are going to make major monetary policy reforms so that the economy does not collapse? Thank you.
Honorable Jonathan Odur, a good listener that I trust. I'm sure you heard what the governor.
Thank you very much, Chair. From the moment the governor started his submission, I have been grappling in my mind with what's going on in this country. What we are doing today, Chair, is what should have been done by government. Talking to the central bank, talking to FIA, talking to Makerere universities, talking to banks, talking to literally people who should be the stakeholders. But from all of them, as they have appeared here, they seem to be so confused about who actually brought this sort of legislation here. That's the ugly position government has put us into it. Because I'll give you an example, Chair. Clause 13 of the bill, which talks about prohibition of economic sabotage. If this bill was to be passed as it is, the deputy governor would be in jail before you assumed that position of deputy governor. Professor Nwagaba, you agree with me? He would be in jail. I'm a keen observer and reader of public information, and I used to read a lot of your articles. And some of them could actually be interpreted as sabotage because they are so critical about some government policies. How on earth do you criminalize research and thinking and criticism for purposes of improvement, or abandoning a policy which is not working? If the Minister Kahindo Tafile had the courtesy maybe of talking to you, I mean central bank, maybe we would not be here today. You would have sorted out this sort of problem. FIA, I think you are doing a pretty bad job. Otherwise, why would we have this law if you people were doing what we mandated you to do? You remember we set you up by an act of parliament because we thought everything here which has been brought, you would be able to handle it. Is this a confession that actually you failed in your duties and therefore we are setting up a parallel system? And since the bill came up, have you two, either Bank of Uganda or FIA, talked to your line minister, say what is this going on? If you haven't, then you're not doing service to some of us. I think we should be doing other things. Let government come prepared after enough consultation. So the problem, Chair, is lack of consultation.
Prior.
Of course, prior. And the public should be extremely happy with us because we are doing what cabinet should have done or the minister should have done. Having said that, not to be critical, let us look at other jurisdictions that have had what we call over-regulation. I don't know, and this, I'm talking to the central bank. A country like Ethiopia, just look at the financial regulations they have had over years, the financial regimes they have had over years, and whether they have since then moved away from that restrictive financial regulation to a more liberal one. Reason is for purposes of attracting investment. We need to have regulations in place that makes business easy and attractive, somebody with money. But if you have too much regulation, I can tell you, no serious person with serious money will bring his money here. That you need to put in $5–10 million, then you must go to Ginger Road. There is an office there, Ginger Road, we call the Minister of Internal Affairs. And you start lining up looking for a certificate from the minister. and the chair, he raises a very important point.
He did.
Because one, cross-border transactions now are so digital, even internal transactions. Tell me how we shall be doing this. This law envisages paper certificates. People to go to the minister's office and sit there, say, you know, I'm remitting $100, or somebody is going to send me $100. So there is a big problem, but as you go back, I think you need to engage your minister. He should have raised this issue in the cabinet. Other than you people coming here to the public, and now you can see the sort of conversation we are having. Like government institutions seem not to agree. And that's quite ugly. Government institutions should be agreeing. So by the time you bring a bill to us in Parliament, you should have agreed as government departments, agencies. There must have been enough consultation. Chair, I think they have done, said it all.
Thank you, Honorable Katuntu. Yes, Honorable Gilbert.